Welcome to Financial Reporting Conversations, brought to you by Basford Consulting.
We're here to make the unknowns and knowns of accounting, auditing and climate standards known, so you can avoid the blind-threading mistakes and do financial reporting better.
Each episode will unpack what the standards really say, what they mean in practice.
Whether you're a preparer, auditor, director or litigator, our aim is to help you get it right.
Hi everyone, and welcome to the discussion on what we've seen in the June 25 reporting season. I'm Wayne Basford and I'm joined by Judith Leung, and we'll reflect on the key themes and issues emerging from this year's financial reports. Over the last few months, we've reviewed a wide range of annual reports, and today we'll be sharing some of the common technical accounting issues we've come across and the kinds of questions we've been getting from clients and preparers in the lead up to the 30th of September. Our aim is to highlight the trends and challenges and a few practical insights that might help next year's financial reporting go smoother. So Judith, we've had no new accounting standards. Everything's the business as normal. So when you've been reviewing all these sets of financials, some of which we reviewed last year and the year before, am I right to say everything's gone smoothly?
Not quite there yet. We're working there, but there are still quite a lot of issues that keep popping up.
What are the recurring issues that keep on cropping up? So what is causing you to pull your hair out, or me to pull my hair out?
There are a few, but the common ones that keep coming up are accounting policies, the cash flow statement, segment notes, revenue disclosures, and one that keep popping up this time is restricted cash.
Okay, so that's interesting. Let's try and get everybody to understand what you're seeing, what we're seeing, and with an idea of please don't do it next year.
Yeah, so accounting, there's sort of two sides. One side is that they've got too much information on accounting policies. They've haven't sort of cleaned up a boilerplate. They might have used a set of model financial accounts, but they haven't tailored their the accounting policies to describe what the situation that applies to them. So accounting policy is meant to describe how you account for things that the entity has or the transactions. So for example, if you don't have financial assets at fair value through P&L, you don't need a accounting policy note on financial assets at fair value through P&L. Or if you don't have any derivatives, you don't need a hedge accounting note because you don't do hedge accounting. So, so on the other hand, there are people that miss accounting policy notes if they haven't explained they've got a complex transaction that has occurred. They haven't explained how they've accounted for it so that users can understand that. For example, if you've got a major restructuring, whether are you bringing that in as a business acquisition, or as whether it's under common control, or if you've got a reverse acquisition, how have you accounted for it? Some of those disclosures are missing with accounting policies.
One of the things I hate is the revenue policy disclosure. I know IFRS 15 says you apply a 5-step approach, but I would love to read from the accounting policy how the entity applies the 5-step approach and which are the key judgments in those 5 steps. But all I get is we list out the 5 steps and it informs me that, yes, I can read IFRS 15.
Yes, that's right. So accounting policies are not meant to regurgitate the standard or copy paste from the standard of how you account for things. It's about explaining how the entity itself applies those accounting standards.
Okay, now cash flow statements. IAS 7's been around forever. What problems have you seen on cash flow statements?
Because everyone's so familiar with the standard, they think, nothing changes. And there actually have been tweaks in the standards throughout the last 10, 15 years that people actually haven't picked up, like that clarify. For example, investing activities, the cash flows in investing activities have to relate to something that will be an asset. We deal with a lot of E&E companies. For E&E companies that have a policy of expensing all their E&E, that the cash flows that they spend on E&E should be shown as operating because they're not going to capitalize an asset on the balance sheet. And same with any software that, intangibles that, you don't meet the intangibles recognition criteria, that doesn't become an asset. Those cash flow spent needs to be presented as operating, not investing. And then another one that that keeps coming up with is net debt reconciliation. That was also amendment to AASB 107. That was an introduction. I think a lot of entities seems to have missed that amendment, that requirement.
It is a useful disclosure.
Yes, yeah, it is a useful disclosure that, so what that net debt reconciliation that's commonly known is you need to show liabilities from financing activities, so your long-term debt or your lease liabilities, and a reconciliation between the opening balance and the closing balance, separated between the cash movements and the non-cash movements. So the cash movement should tie back to your cash flows from your financing activities. And then you should show the non-movements are like, for example, FX gains and losses, or if you've got a business acquisition and you've got a new lease being brought onto the balance sheet, then that's actually a non-cash movement. So a lot of entities, that disclosure is missing.
And you mentioned as we went through it, the new one or an area that's cropped up a lot this year is restricted cash. So what have you been seeing and what's been going wrong?
So it's always interesting when I see restricted cash, because then some of it is they need to explain, the nature of restricted cash is, and that sort of ties back to our accounting policy comment about not how it applies to that entity. Restricted cash, sometimes when I see it, then my first question is, do they control the cash? If they don't really control the cash, then it's actually not their cash, and they shouldn't be showing it as on their balance sheet as their cash. And so there are questions that I typically ask clients with, what's with this cash? Is it sitting in a separate bank account? Can they touch that cash? Do they earn interest from that cash? If this whole entity goes, it's into administration, does that cash is ring fenced to who it belongs to, or it comes through, it's accessible by the greater credit pool? So it's, it's the key question is, do you control that cash, or you're just holding it on behalf of someone else? Basic
concept of an asset. I control it, therefore it's an asset. I don't control it, it's not an asset, not even cash.
Yeah. That's right.
Okay. Now, I know we just pull our hair out every year, and Australia just seems to just not understand AASB 8. What have you been seeing on segment notes, and what should they have been doing, and what have you been seeing?
Well, a very common thing I see in segment notes in a lot of our accounts in Australia is that most entities only have one segment, and that is the segment that's being reported to the chief operating decision maker. That's the results that's being reported, and that's what AASB 8 say. That's the like a segment is you show from the management's view of how you run this entity, and then you've management, the chief operating decision maker, is getting reports and results at that high level. That is how you disclose your segment. So, but if I believe that, and then I go into when I consider all the consistent information from directors' reports and investor reports, I see directors discussing their operations and how each product is going, each geographical region, if they're in Australia or Asia Pac, and what the results are. And I'm sitting there wondering, well, that seems to be a bit inconsistent, where I'm reading the financial statements and they're saying that the chief operating decision maker is only getting that high level one entity information, but the directors seem to have a completely set of detailed information.
I look at it, and you look at the REM report, and you look at how well some of these chief decision makers are paid. And then you look at the segment note, and no, they do not look in any detail at anything going on in the business, any new product, because they only look at the bottom line or the top line revenue, and they never ask for any detail on how their group's going. What does it say about the chief decision operator, or what does it say about complying with AASB 8? So the next one you mentioned, revenue disclosures and all those great disclosures of disaggregation in AASB 15. Are people getting any better, or what are you seeing?
There's two things that I keep seeing in revenue. One is that, things being presented that are actually not revenue, but presented as revenue or other revenue. So the first thing is that we need to only present revenue as those ones that fall within the scope of AASB 15. Other things are either income or gains and losses. So, FX gains and losses, I've seen that's been put into revenue. I've seen government grants that's been put into revenue. Those are other income or income. So that should be separately presented and not core revenue. This was something recurring. We did an article last year on this, and it's still coming up quite a bit. The other thing is, like you've said, it's the disclosures and disaggregation of revenue, which meant to tie back into your segment note as well. So if you to do it properly, there is actually an illustrative example at the back of the stand. If you to do it properly, you almost have like a matrix of all your segments, and then also by geographical region, you meant to the level of detail that AASB 15 requires is actually quite specific. It's, if you've got different products, you should disaggregate them. And again, if I go back to and read the director's report, the director's reports are discussing the results from different products or different customer segments. If you're selling to government, non-government, and also geographical location, that also need to be broken down into that level of detail. So it's something that a lot of entities are not showing.
And 15's been around for 5-6 years now, and it's worrying just how long things take to get right when we're adopting IFRS. Thanks for that, Judith. Now, I know your love is financial instruments, all things IFRS 9. So what questions or problems have you been dealing with this reporting season?
So one of the things is modifications and renegotiations. That keeps popping up. And some people, you hear a passing comment about, they've got their loan renegotiated, and so, nothing's changed, or they've increased their loan, or if they've just extended their loan. When I hear these things, my mind automatically, so you should expect to see a P&L impact on a lot of these. And, when I ask them, like, the first question you need to look at is whether that modification is substantial or non-substantial, and go through, like an analysis of whether it is substantial or non-substantial, and, whether that, like, you need to essentially reset the EIR and effective interest rate and the P&L impact that modification or renegotiation will have.
And would you think that would be one of those key judgments that might be disclosed as and when you've decided it was not substantive?
Yeah, sure. Of course, that needs to be like in your accounting policy note, and this why was it substantive or non-substantive? Did you do it because of the qualitative threshold or the quantitative threshold? So that should be clearly explained.
I've read a lot of financial statements this season, and I'm not sure whether I've seen anybody explain that judgment and even mention the word quantitative or qualitative in any of their judgments and accounting policies. So very theoretical, but it's not happening.
And the other thing, one of our pet topics is convertible notes and derivatives. And so, again, just when I look at a set of financial statements, when I see equity, that was the first question I will ask is, does it meet the fixed for fixed test for equity classification, or is it a derivative? And the other thing that also popped up is a lot of these derivatives, whether it's warrants or your own shares that are up, they are actually a level 3 fair value disclosure in level 3 fair value measurement, because the volatility, even if you're a listed company, the implied volatility that you use to input into a option valuation model is unobservable, and that's a significant input. So that should be a level 3 measurement level under AASB 13, and that actually requires greater disclosure than if it was a level 1 or level 2 disclosure. So you will have to show like a reconciliation table, details about what the inputs are, and sensitivity analysis.
Sensitivity analysis. Again, I see lots of sets of financials with convertible notes and options, but I don't see many level 3 disclosure tables, because they're a complicated area to look at and get right, and potentially highlight all sorts of interesting judgments of what you believed were the non-observable data. Anything else on financial instruments or?
So one last thing about connotes, it's one of my pet topics, is that we had a liabilities amendment to the classification of current and non-current liabilities, and if it's a derivative liability and the holder can convert the note into equities at any time, and the derivative, that needs to be shown as current, not non-current. One of my review points is, can we check the conversion terms?
I know in our accounting update and our training, we tried to hammer that was the interesting change this year, but it seems not on the right ears in all occasions.
If you're finding this discussion useful, please take a moment to click like, subscribe, and share. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode.
Now, I know financial instruments is your love and passion in terms of weird accounting, but you seem to be also diverging into share-based payments and AASB 2. So how did we go with share-based payments and AASB 2 this season?
3 things that keep popping up. So the first one is there is a lot of confusion about what vesting conditions are. AASB 2 has a very defined, specific definition of vesting condition, and vesting conditions are, we've used it all the time. You can see it in share-based payment, share arrangements, options, and your vesting conditions is if share price reach so and so, or if you've got a mining company, your gold production reaches a certain level, then that's when your shares vest, and that's when management is getting those shares. But vesting conditions under AASB 2 is very specific that you need to, by their sort of interior definition, it needs to contain a service condition. So if the CEO left and you're still going to get those shares, then there's no service condition involved in that. And then that becomes, under AASB 2, a non-vesting condition. It's still a condition that determines whether you get the shares or not, but it's classified as a non-vesting condition, and you measure them differently to if it was just a service or a non-market performance condition.
You measure them like a market condition?
Yes. So, yes.
So the probability and all of that overlay gets buried into it?
Yes. So you need to measure like market condition. You look at whether it's probable, like you measure what the probability is, and you factor it into the fair value as your share-based payment expense and initial recognition, and you don't true up. Whereas, if it's a vesting, that is a condition that is service condition or non-market performance condition, you don't factor into probability, but you get to true up if production of gold doesn't reach that level. So when people see it, they just think, okay, it's a non-market performance vesting condition. So, that's what I do actually. But if there is no service conditions, it's actually a non-vesting condition. So that's one thing. The second thing that's keep popping up, I thought, we've sort of moved, but I'm seeing director loans on the balance sheet, and then I'm going into the equity note, and then they say they've issued some shares there, and then then I ask, and then the loan conditions says that this loan to the director is secured against shares of the own equity. Those are actually, most of the time, if it's non-recourse, then that's a AASB 2 share-based payment. So it's actually a share-based payment expense.
When we band around wonderful things like non-recourse and limited recourse loans in our world, what does that mean for real people? What does limited recourse mean in the context of these loans?
You actually don't have a loan. You actually got a share-based payment expense to that you need to record share-based payment expense to the director. You're almost giving the directors an option to purchase those loans. If they decide to repay the loan, that's when they purchase those loans.
But the limited recourse thing is that you're going to default on that loan. You're not going to pay me $1 million for those shares because they're now only worth 500,000. So in order to settle your liability to the company, you will just push those 500,000 worth of shares back to extinguish $1 million loan. And then we're all square. But if the shares go up and the loans for $1 million, the shares go up to $2 million. Well, of course, I'll repay that $1 million loan. I might sell some of those shares to pay you the $1 million loan. So it's an option. I only get the benefit when the share price goes up. If the share price falls,
there's no risk.
Here's the shares back. We're square.
Yeah.
And it's an option. But
yes.
And under AASB 2.
Yes. Yeah. So, that's caught a few entities surprised.
And anything else on AASB 2, or we're
the third last one. So the third one that we've seen is it's more around disclosure on shares issued to parties that are non-employees. And AASB 2 says that if you've issued shares for services and goods, then you need to measure them at the fair value of the goods or services provided. However, there's a rebuttable presumption that if you can't measure those goods or services reliably, you can measure in relation to use of the share price, the value of the equities that you've given. So a lot of people I've seen they just say, oh yeah, this service is measured based on the shares issued, but you need to actually disclose in your accounting policy note or in the AASB 2 note that you've used the indirect method, because that's actually a disclosure requirement into.
I do find this is it's an Australian IFRS, it's an AFRS, or more worryingly, it's a Western Australian IFRS, which is even a more scary variation on it. When I speak to the guys in London or anywhere outside of Australia, you can't rebut that. It's so rare, the circumstances you'd be able to rebut that presumption, where in Australia, of course we rebutted. We couldn't possibly value that good or service. And then you ask the question, well, how did you actually work out how many shares you were going to give them? This concept, is there a sorting hat? I just randomly select. We have a gambling system of I might give you 1 million shares. I might give you 1.5 million shares. I might give you 2 million shares. But we don't know how much that good or service was. I've always struggled with this argument with clients, and it still continues. And the point to really pick up is if you are going down this very peculiar route that I actually pay for goods and services in shares, even though I don't know the value of those goods or services, we should properly disclose that in our accounts just to say that's the way we do things.
Yep, that's right.
It's a strange world we live in. Okay. Now, I know one of the interesting aspects that we seem to be cropping up on a number of our projects and clients, agent versus principal. So, and again, I apologize. So, can you talk us through the principles and what people should be looking for when we're considering agent versus principal? And I know agent versus principal doesn't really fit into the 5-step approach. It's a question of where does it fit into the 5-step approach, but it leads to some of the largest misstatements when you follow IFRS 15 or revenue recognition.
Yeah, so here we're talking about, you're asking Wayne about principal and agent in the revenue context, and it does make a big deal because, if you're a principal, then you get to recognize the revenue gross and you've got you show an expense. If you're an agent, you're only getting that. So say example, revenue 100, the goods or services 95. If you're an agent, you only recognize the revenue net, which is only 5. So it does make a huge difference to people's P&L statement and the revenue line.
Line, the net is the same.
Correct, yeah. AASB 15, it doesn't fit in the 5-step approach. It's in the application guidance, but it's something that people don't quite understand how principal and agent work under 15. So 15 is all about control of the goods or services. When do you transfer that control of goods and services to the customer? You recognize revenue when the customer has control. So when you talk about principal and agent, it's along the similar vein. If you're a principal, you would have obtained control of the goods and services, and then you would have transferred the control of those goods and services to the customer. If you're an agent, you're just I like to say conduit or an arranger to arrange for that transfer of goods and services. And 15, the first thing you need to sort of go through when you go through analysis, the first thing you just identify is what is the performance obligation? What have you promised the customer? What is the good or services that you've promised to the customer? Then there are 3 indicators. So the first thing you need to look at is who does the customer think is the entity that's the primarily responsible for providing you that good or service. And then 2 is, does it have, the principal should have inventory risk. And 3, the principal sets the price. So those 3 things are the 3, what the standard says are 3 indicators that you have control of a good or service. So if you're an agent, you don't really control the good or service, but you're just transferring, you're just arranging for that good or service. Then you recognize it net. And a typical so if you're a principal, then the customer sees you're the one that's providing the good or service, not the one that's arranging for you to receive the good or service. So if something goes wrong, who does the customer go to get compensated? Who does the customer think is responsible for providing them the good or service? And the typical examples that people might be familiar with Uber, the good or service, it's actually in Uber's account under their US GAAP, but then US GAAP and IFRS is the same. Uber is actually
the same.
Yes. Uber is actually an agent because when I go for a ride, we know that is the driver that's providing me a service, and Uber is just there to arrange for that ride service. Same with Groupon. When I go, it's actually Groupon is an agent, so Groupon. When I get a discounted meal, when I purchase a deal on Groupon to a restaurant, it's the restaurant that's providing me the meal, that service. Groupon is arranging. So Groupon and Uber, they recognize revenue net for these.
I know this is a topic we must do some training on. I know we must put some more newsletters out, because if I look at how do you materially misstate your revenue, what are auditors missing, and even what are some preparers missing? It's just you overstated your revenue by 95% is a scary thing. That revenue recognition is always a significant risk of material misstatement. You got it wrong by 95%. Should be keeping some auditors awake at night. So I think wrap it up on the last thing that I know we've been talking about a lot, and I know possibly you've been upsetting a few of our clients or our audit firms that we help. Accounting for SaaS, software as a service, and you explaining to people what the IFRIC have made clear to us all. So what's going wrong with software as a service and the IFRIC interpretation?
Yeah, so this is the big one because a lot of entities spend significant amount of money on this, and yeah, in this busy season we've had quite a few that has some nasty just surprises on the amount that needs to be written off as an expense. So the IFRIC actually had two interpret agenda decisions on these, and typically with these SaaS, if you've go through a SaaS implementation, there is typically a license fee you pay for the cloud platform. So like Salesforce is a very a popular one that people migrate to. So everything's hosted online, and so because everything's hosted online, it's not, you can't control that intangible that's up in the cloud. So the IFRIC, the first IFRIC agenda decision said that that's not your asset. What you've prepaid for that license is actually a prepaid service. So rather than recognizing intangible asset, you actually got a prepaid service that you amortize over the life of your license fee arrangement. Then in a typical SaaS sort of implementation, you've got the configuration and customization costs, and then you've got data and training costs, so migration costs. The configuration and customization cost that's the big one that people we're having a surprise about. So that one, because
it only works for me. I'm spending all this money that it's my bit. I'm the only one getting the benefit from it.
Yes.
So why can't I capitalize it?
Well, the issue is because the license fee, the software that you're making all this customization thing is not your asset. So you can't, and you're sort of customizing the, so Salesforce could be very generic, and you're making it to be tailor specific, like you said, to an entity or particular industry to work. You're building, not building, sorry, but customizing what the code, but that you don't control it. The issue here is you can't control the code. The only way you can capitalize it, which after a lot of conversations is actually very small. You can only capitalize things that you can. If you say it's your code, it's for your benefit, even though it's your code, it's for your benefit. But if that code the question is, can you download that code and attach it to another software that still works? Sometimes that's the only way you can capitalize it, because what the IFRIC said was those costs you can only capitalize if it meets the definition of intangible asset under AASB 138. And to do that, not only you can have benefits flowing from it, because like the constant argument that we have from clients is that, yes, I'm going to benefit from it. Like you said, it's my code, they've written it for me, and I'm going to use it for over the license period. But the question is, can you actually separate that? Is it separable? Because the definition in intangible assets is that it needs to be identifiable, meaning it can be separated and you can be transferred to another system. And that's where people fall over when we say, can you actually download the code and use it somewhere else? And a lot of cases you probably couldn't, and therefore you need to expense it. And also, again, a lot of companies spend a lot of time, a lot of money on migrating the data, training. That's all needs to be expensed.
And they're going to get benefit from all of this great technology, all of this cloud for a long time. It makes economic sense, but the IFRIC, the accounting standards, IS 38 says expense it.
Yes. So the customization configuration cost, if it was paid to the same provider as your license, if you're paying to Salesforce, then there's an argument to sort of, and if it's all sort of together, then there's an argument for you to spread that expense over the period of your license. But most of the case, these customization configurations are actually done by a third party. So that is when you end up having to expense it all upfront.
Thanks, Judith. Now, I think it's a good time to wrap up, and to help the listeners to remind, this is what we saw and this is what we're hoping people will avoid next year. And there is a bit of my plan of this is to actually, before next reporting season, is to rerun this summary bit to say this, as a reminder, this is what we saw in June 25. Please make sure it doesn't happen in June 26. So when it comes to disclosures, even though we've had no new accounting standards, apart from the insurance standard, we've had no new accounting standards for a long time now, we are still seeing problems with accounting policies, boilerplate accounting policies, or just missing accounting policies that are relevant to us. We are seeing very surprising segment notes and only one segment, even though we operate in 6 different countries. And according to the director's report, we have got 5 new product lines in 4 different continents. We've got problems with disclosures on revenue, disaggregation of revenue, and people have just not complying with the requirements of 15. When we're coming to topical issues that could lead to material misstatement, people are still struggling with IFRS 9, are struggling to think or even recognize whether we've modified or whether there's been a significant modification of a financial liability. They are still struggling to work out disclose level 3 disclosures on options and convertible notes. I think in all fairness, they're still struggling to work out what is a convertible note and whether it's a derivative and what it's a compound. AASB 2 is still confusing everybody, and the concept particular of limited recourse loans, it's actually creeping up. I think limited recourse loans as a means of remuneration is increasing. Must have some, and people then treating them as a loan and as receivable as issue shares is actually going back to where we were 10, 15 years ago. The concept of non-vesting conditions and how you treat non-vesting conditions, again, is something that too many preparers and accountants and auditors just don't put their mind to, and how you can do that. Again, I do horribly look at too many audit files and too many risk files, and revenue is always a significant risk of material misstatement. But how many discussions and questions do I get on agent versus principal versus what I should be getting on agent versus principal? I really think people should be paying more attention to it for next season, next half year. And as a reminder, as we're all moving into the cloud, as we're all having software as a service, and we're spending more and more money tailoring it and all the beautiful ability to get our systems working in the cloud more and more efficiently, we must remember to expense all of those costs. The fair summary?
Yeah, perfect.
Thanks, Judith. I think I've learned a lot, and you've explained some of these things really well to me. So hopefully everybody listening can do it. And for everybody listening, thanks for watching, and please watch out for our next videos that try to help people practically understand how the accounting standards work and how to avoid making material mistakes. So thank you very much. Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards, or to access our online training programs, please visit basfordconsulting.com.
Don't forget to like, subscribe, and share this episode with your colleagues and contacts. We'll see you next time, where we make the unknowns in financial reporting known.